Hello and welcome to Your Money, Your Call. I'm Kim Slater, filling in for Chris Kimber, who's unfortunately sick tonight. If you have a question about shares, our phone lines are open on 1300 30 34 35, or if you prefer, you can email us at yourmoney@skynews.com.au. Great to have you with us tonight. Tonight I'm joined by Simon Gazowski from Beresford Financial Planning and Russell Muldoon from Montgomery Investment Management. Gentlemen, welcome to the program. Chris. Russell,
Sorry,
you're falling into that old
Sorry.
trap. Today, the lightning rod for the market was obviously the CPI figure, so good news if you'd bought a TV, travelled, drank soft drinks, didn't eat veggies or go to the doctor or rented and didn't spend on education, then you obviously got the benefit of the lower CPI. We've got an annualised figure of 1.2%. 37 of the 87 baskets recorded annualised increases of 2.5% more, so a bit of a mixed picture coming through, but overall, the headline figure is the lowest we've seen in 13 years. Market liked the look of it. Russell, your thoughts on rates?
Yeah, look, I think I have a view that an easy way to sort of work out where interest rates are going to go over time is add together GDP and inflation. So if inflation rate, as we just heard, was 1.2%, now GDP is running at 2.5%. That means our interest rate should be tracking between 3 and 3.5% now. The cash rate at the moment is around the 3.5% mark. So look, the IMF said we're downgrading forecasts for Australia down to around 2%, inflation at 1.2. So look, there could potentially in the pipeline be another 0.25% cut coming from the RBA very, very soon. So I think it's a very good benchmark to watch if you're trying to look at interest rates. You're trying to watch where they're trying to go. Simple formula: GDP plus inflation. So obviously when the cycle does turn and GDP starts to improve and inflation starts to rise again, we'll see interest rates.
So is is your thought the RBA is going to move in one cut, or is it going to be a series of orchestrated cuts, say between now and Christmas? So Russell,
look, I think we're probably due for a 0.25% cut, more so than a 50 basis point cut, and the reason for that is basically because of my formula: 1.2 plus 2.5 gives 3.5. So look, I'll go in between that and say 0.25%.
Okay, well, Simon, back to you. The obviously the impact of interest rate cuts means that term deposit rates are going to come down. So, for those self-managed super funds that everyone's been told to get into cash, they're going to be looking at term deposit rates 6 or 12 months, which are obviously going to be at best approaching where the current cash rate is of 3.5%. The Australian equity market is looking more compelling as we speak, with on a global scale at the very least, with a dividend yield of 5% and improving income growth profile. Putting aside the resource sector at the moment, because that seems to be in a category of its own. What are you saying to people to actually buy as a replacement for income from term deposits? What would you be suggesting? Very quickly, Russell. What are your say top two, three picks?
Well, I'm going to hold one for the stock watch coming up very, very shortly. But look, we have in terms of significant weightings, we have CSL and Macmillan Shakespeare as our two largest holdings at the moment in the fund.
Okay, well, we'll move on to our first caller, who's Wilma from Melbourne. Welcome to the program, Wilma.
Hi. Look, I took a little punt on this Gerard Lighting, GLG, and I've been told that they have had an offer of a takeover. Would you know anything about it?
This was in the paper the other day, I think. I saw something on it. Simon, have you seen anything about Gerard Lighting?
Haven't seen anything
Russell,
on this one.
What about you?
I did see something flash past my screens, but I haven't actually looked at it because it isn't a business that's popped up on a radar. Unfortunately, was it Wilma? Was it called?
Yeah, Wilma. Well, unfortunately, you seem to have struck out with our expert panel tonight, Wilma, including myself. I did see there was a headline, but did you buy your shares online or did you buy them through a broker?
No, franking credits and things.
No, did you buy your GLG shares through a broker or did you buy them online?
No, I bought them. No, my financial advisor buys on the internet for me.
Okay, well, my best suggestion would be for you to go back and have a chat to your financial advisor, because he'll be able to call it up on the screen and see what the terms of the offer are, and he's probably in a better position where we're relatively for once uninformed on this, I'm sorry. But we'll move on to an email, and this is from Maxine in Victoria. Maxine is asking what our price target is for Woodside, and is this a stock for a good long-term investment? Now, Simon, this is an interesting one because we've had the quarterly production report, and it was a corker. You know, Woodside's come out blazing, or with all guns blazing with the Pluto production report. Stock's up about a couple of bucks in the last couple of days, you know, contrary to the market trend. What are your thoughts about this, and where could it possibly go to? Russell, you guys tend to look at valuation streams of earnings and take valuation streams and discount them back to arrive at, whether, it's an A2 or whatever the combination of various letters and numbers are. With Woodside, what's your model sort of spitting out at the moment? Is it what territory is it? Is it in accumulate, sell, or hold?
It's none for us. Look, we generally focus more on the industrial side of the market rather than the commodity side. This is a business who, despite all the significant investment back into the business and the capex spend, is going to generate around $2 billion on $12 to $14 billion of capital, a return on equity of about 15%. Look, half of that return you would imagine is capital that's required to reinvest back into the business just to maintain machinery, equipment and infrastructure. So look, you're probably getting a 7% free cash flow return on this business. We prefer companies that spit out a lot more free cash flow that can reinvest into growth and organic growth. Look, this business is a true Australian success story. It's been around for 30 or 40 years, has some great long-term assets, but in terms of valuation, we're nowhere near the current price, unfortunately.
Well, time will tell who's right or who's wrong on that one. But okay, we'll go to Tim from Carina. Welcome to the program, Tim.
Good evening.
What question have you got for the boys tonight?
I'm just calling in regards to Vocus Communications, VOC. They've recently issued a capital raising, so I've taken part in that. I've dumped all my stock at $1.72, and I've taken up the offer. So I just want to know if long-term is VOC still a good stock, and is the capital raising a good thing, or is it a negative sign?
Well, generally, I guess you can always say that when a company's recapitalising its balance sheet, it's a good thing. But the interesting thing will be what plans management has to spend the capital on. If it's going to repay debt, well, that's like Seven West Media is doing. That's a great thing. If it's planning to spend the capital on buying further acquisitions, well, you need to have a quick look at the acquisitions and generally try and put a line under them and see whether when they're going to generate cash for the company and whether they're going to be a good acquisition and whether management's got the ability to actually handle those acquisitions. But this is not a stock.
Do you want me to have a go at Vocus?
Step up to the plate if you know something about this, Russell.
Yeah, so Vocus started life. They own some capacity on the Southern Cross pipeline that runs from Sydney all the way to the USA. And what they've done is they've purchased capacity through Southern Cross. They own that. They wholesale that to iPrimus, to Optus, to Telstra. And the reason these guys will buy capacity from a Vocus is mainly for redundancy. So that if they go down, they got another pipe coming in from somewhere else, which they can then back up their systems to. The company is also involved in data centres, and that's the key growth area for the business and a main reason for the recent capital raising. So I think from that capital raising you could probably expect the business to make 2 or 3 acquisitions in that data centre space. We actually participated in the capital raising as well. We know the business intimately.
What price was the capital raising at?
$1.63, and I think they're trading around $1.70 at the moment. Mm-hmm. So James Spenceley, we think, is excellent management, and the team is largely from Pipe Networks. Now, Pipe Networks was taken up by TPG a couple of years ago. There's a few members on the board from Pipe Networks, Steve Baxter as an example. Look, this business is being built to be sold, and that is their clear endpoint for this company. So they'll grow their fibre network, they'll grow their capacity lines, they'll grow their infrastructure, and eventually this business will be at a size where it'll be a reasonable acquisition for someone, and I think that's the business plan.
Well, thanks very much for that. That was a very, very detailed broker's report on that one. Before we go on to our next caller, let's just briefly focus on the on Australian residential housing construction, because we've had one or two brokers pop up in the last couple of days and saying they're getting a lot more upbeat on Australian residential construction. I think Goldman Sachs is actually saying that their price valuation models are suggesting that housing has returned to near fair value, and we may actually see a fairly significant upturn in some of the building stocks. Like we're looking at Boral, Fletcher Building. What else have we got there? Mirvac, Pete, Alesco, and the like. What are your thoughts? Are these guys pulling the trigger too early, Russell, or is it? Do you think there's the data is genuinely there to support that theory?
Oh, look, I haven't looked at the data because it's not a sector that we're focusing on at this stage. The building industry is not one that our investment team has focused on with any great detail. So, look, there's probably not a lot of value I can add to this. Saying that, look, this is a classic bottom of the cycle investment pick. If you think the market is going to turn, look, building companies, building stocks, the real estate market is one that will turn with the general economy. Now, we saw that inflation's coming down, GDP is being lowered, so growth forecasts for Australia are getting lowered. So look, until that we start to see inflation pick up and GDP pick up, I don't think we'd be interested in the building sector.
We're seeing that with inflation. I mean, obviously, rent, one of the categories that the Reserve Bank was saying went up today by about 1.1% was rent. So obviously, if you've got that interesting trend where rents are going up and interest rates are coming down, when we see these mortgage rate cuts that should flow through, obviously this is going to be a sector that really does start to fire up. It's time for a quick break, but before that, it's time to start the stock watch. Russell, what stock are you watching? You've got 30 seconds. Go.
Are we ready?
Go.
Okay, so a business that our investment team has prioritised to research in this upcoming reporting season, a business that we own in the Montgomery private fund, is actually a significant weighting, and also a business we've mentioned 2 to 3 times in the last 6 months on the show at $5 to $5.30 is Credit Corporation. The share code is CCP. And we think if management can hit the top end of their forecast given recently, and also if they can show growth for FY13, then we think the business is worth more than $7. We think it's one to watch.
Time out. Well done. Welcome back to the program. I'm with Simon Gazowski of Beresford Financial Planning and Russell Muldoon from Montgomery Investment Management. That is a mouthful, Russell. I should say, Simon. If you have a question you'd like answered, give us a call on 1300 30 34 35 or email us at yourmoney@skynews.com.au. Now we'll go straight to Robert, who's been patiently waiting on through the break. Robert, your question for the panel is?
Hi, Kim and guys. Look, can you guys give me an opinion on a couple of blue chips that I've been holding, Silex and Boart Longyear, SLX and BLY. Now, they seem to have one common thing between them. They're getting their share price absolutely smashed by all this shorting that's going on and the algorithms. Now, a lot of the trades today and most days in Silex, like they're under $30 in value, and they're often, like from one trade to the next, they fluctuate both directions by as much as 10 cents. Like today at 3:30, there was a trade at $3.83 for a couple of grand. The next trade 2 seconds later was for $3.93. It was for 5 shares. It went up 10 cents for a $20 trade. Now, I'm coming from a retail trader's angle. I've got to pay $20 brokerage on each trade that I do, and I've got to buy a minimum of $500. And these hedge funds don't seem to have to do that. Boart Longyear's price has nearly halved in the last 4 months. I've watched it fall from like $4 something that's now like $2.45. And just in the last 3 weeks, it's fallen from $3.12 to $2.45. And I saw in the Business Spectator about a week ago, Robert Gottliebson, who I've followed for many, many years, he's quite a smart guy. He wrote a couple of pieces in the Spectator about market manipulation by hedge funds, which makes me think this is exactly what's going on here.
Well, I think what Robert was referring to was high-frequency trading, which has been outlawed in the States, and that's something that the ASX and our regulatory authorities are going to look at, because the whole purpose of high-frequency trading is to clip the tickets ahead of the retail and other institutional investors. In the old days, we used to call it front-running, but it now has a fancy title, and computers execute all the trade. So I take your point. I mean, Boart Longyear has just been belted along with all the other mining stocks, and obviously at these sorts of levels it's good value. And Russell?
Oh, look, I couldn't agree with Simon any more on that. Look, we exited completely all our mining services businesses right at the start of the year. Look, we have a very strong view that the CapEx cycle has peaked in Australia for our miners. BHP and Rio are 40% of the entire CapEx pie. We just saw recently BHP planning or to reconsider a large number of their projects. A lot of projects are being pushed out. And just recently I read another article that there's been a complete moratorium by BHP on all their greenfield exploration projects, and this is really the bread and butter sector for Boart Longyear. Boart Longyear will go and explore an area for BHP, they'll look for minerals in the ground, and then they'll assess whether or not it's economical to build some infrastructure and dig the resource out of the ground. So look, we're very cautious on mining services in particular in this cycle. We're not there at all. We had a significant investment just 6 months ago, but look, our view is that yes, the sector does look cheap. There's a lot of value, but look, analysts will just be playing catch up in coming periods.
Well, what about Silex in this situation, which I think is in uranium enrichment? You've got any comments on that?
No, not really. It's not a company we follow. Look, the only thing I know about Silex is got the uranium enrichment, which GM are trying to build a commercial plant to get into producing commercial quantities of enriched uranium, which is going to give them a significant royalty for a number of years. But apart from that, they've really only got their research side of the business and their solar panel cells. So okay, it's not a business that is attractive for us.
What I do want to do is to just very quickly touch on resource stocks. I mean, I know this has been done to death, and we've seen BHP, back in the low 30s, Rio's in the low 50s. But one statistic I thought was interesting, which I thought's worth mentioning tonight, that BHP is trading on a trailed fully franked dividend yield that's now above the Australian 10-year bond yield, and we've only seen this happen briefly twice in about the last 30 years. Once was in December 1998 and again in December 2008. On both occasions, BHP's share price rose more than 50% over the subsequent 12 months. Now, given what's happening with interest rates, given that everybody's saying, yes, valuation-wise, BHP is either neutral or cheap at these sorts of levels, can you, with any degree of confidence, buy BHP at these sorts of prices?
Can I just touch on the interest rate to dividend yield comparison? I think it's very, very risky to be comparing those two figures together. Now, over a 10 to 15 year period, interest rates and dividend yields do show a very, very strong correlation. So when one rises, the other rises. There's a very, very strong correlation there. But over a period of 140, 150 years, there's actually a negative correlation of around 0.2%. So that's what that tells you, is that there's zero correlation between where interest rates go and where dividend yields go. There's just nothing there.
140 years, okay.
Yeah, and well, there was a study that we did in graduate school. Coming on to BHP, look, BHP's profit forecast over the last 12 months has fallen from $22 billion to $17 billion. So profit forecasts have fallen $5 billion. That's a significant fall. You say that potentially dividends can increase, but if profits forecasts continue to fall and profits actually do fall, what is the ability for management to increase their dividend on lower cash flows? Look, we have a view that Europe's slowing, US slowing. China's two largest exports are US and Europe, and in such an environment, then China has to slow, demand for resources has to slow. And until we see a pick-up in Europe and a pick-up in the US and then a pick-up in commodity demand as China gets its export machine going again, we're just really very cautious on this space.
All right, we'll have to leave it there for a moment while we take a short break, but we'll be back with more later. If you'd like to give us a call and speak with our expert panel, give us a ring on 1300 30 34 35 or email us at yourmoney@skynews.com.au. So we'll move on to Suzanne from Newcastle. Welcome to the program, Suzanne. What's your question for the panel tonight? No, Suzanne.
Good evening, gentlemen.
Good evening. I thought we'd lost you there for a moment.
Yes, just for a very brief moment. Mineral resources, if I could direct that one to Russell, I think it might have been a Roger stock at one stage, NRW Holdings, and if you get time, your valuation in preference to 4 banks.
Okay, that's quite a lot to get through. In terms of mineral resources, this business has about 30% exposure to mining services, and about 70% of the business now is minerals production, and predominantly in iron ore. And that chart doesn't look very healthy at all. I'm not sure about Roger having an interest in this business. We've never actually owned it in the fund. Look, our view on iron ore is quite a simple one. The world produced 2.8 billion tonnes of iron ore last year. The forecast to go to 3.1 billion this year. It's an increase of 300 million tonnes. China has historically taken up 60% of that increase in production. That means China should take up about 180 million tonnes, or 6.3 is 18, 180 million tonnes. Forecast is actually for 40 or 50. We think when you have an increase in supply met with lower demand in the order of 140, 150 million tonnes, that there's going to be low iron ore prices. We've seen iron ore come off 9% in 2 weeks. We think that's going to continue. Now, China iron ore production has a cost of production around $120 a tonne, so we're really at a critical junction now to see where prices do move from here. So that we're just not on mineral resources. It does look cheap, but saying that, you have to have a view on where the iron ore price is going to go. NWH is a mining services company. It's involved in the construction phase. There's still a lot of work out there for a construction project, but we're seeing a lot of early indicators that projects further out are getting pushed aside, hence you're seeing significant share price weakness in a lot of the mining service companies. Again, that business we do see as being cheap, but again, we think it's a potential value trap.
Russell, when you guys are doing valuations on the market, obviously when you use these discounted cash flows, for instance, could you quickly give us an idea, what sort of discount model or figure do you use with something like the banks, say, versus BHP? And then how does that lead into how you rank the banks at the moment? What do how do you rank them 1, 2, 3 and 4?
Yeah, sure. Obviously, there's a significant less risk in a bank, although they are very, very highly leveraged businesses. There's significantly less risk in a bank, given the nature of their annuity streams and their recurring revenue from their loan books, their insurance books, their investment management books. There's a significant amount of cash flows that are continuously generated. As we all know, we pay a significant amount of fees for doing business with the banks. So for the banks, we use probably in between 10 and 11% as our discount rates. And then when we come to the miners, we use a minimum generally of 14, and we can go up to 20 for the miners. And the risk is, some of them are single commodity producers. There's significant commodity risk. They have pricing which is completely out of control, huge capital expenditures.
So within that model, when you've got different profiles, so for growth profiles, like you've got CBA, which is basically a domestic mortgage bank, yet you've got ANZ, which has got an Asian expansion program, which has another level of risk in it. How do you differentiate between the two? I mean, do you apply a different discount rate for CBA as to say ANZ?
I guess we're in that situation. We would look at the earnings volatility from UK operations. It has been extremely volatile for National Australia Bank. ANZ yet to really get significant traction in Asia, so it's not really a consideration. Look, our preferred bank has always been CBA. It's Australian focus. It has a significant amount of retail deposits. Unfortunately, as Simon mentioned, it is the most expensive. And in terms of ranking them, I 100% agree with Simon. It's ANZ and NAB are the cheapest for obvious reasons. They have some sort of international exposure. NAB does look by far the cheapest, but of course it has the UK operation issues, and a lot of their capital seems to be flowing from Australia into the UK division, followed by CBA and Westpac.
Right. Welcome back to Your Money, Your Call. I'm here with Simon Gazowski, who we caught like a rabbit in the headlights just a few moments ago. He's from Beresford Financial Services, and Russell Muldoon from Montgomery Investment Management. If you have a question you'd like answered, give us a call on 1300 30 34 35, or email us at yourmoney@skynews.com.au. So, gentlemen, we were talking about the banks before the break, and I think we have a caller lined up who's Monty from Bundaberg, and Monty is on the line, I hope. Monty, welcome to the program.
Thank you. My question is basically Qantas. The stock price keeps dropping. The market capitalization is going down, but the cash in the bank is still there. What do you think their chances of encountering a hostile takeover soon is? And another question on Santa Barbara SPM and their takeover of Allied Gold. How do you think that's going to shake out?
Well, a couple of very interesting questions there, Monty. Thank you for that. Well, Qantas, the whole story is aviation stocks are very, very volatile. The share price chart in Qantas bears that out. Interesting question. The cash is going up, share price is going down. Russell, is this in value territory, or is it what's going to happen? Is Virgin going to bid for the thing, or is someone else going to come in? One of the overseas airlines going to step up to the plate? What are your thoughts on it?
Look, we obviously have a very strong view on Qantas, and you should never own an airline, full stop. Hugely capital intensive. They have to reinvest in new planes. Planes don't get cheaper. It's very sensitive to fuel costs. Fuel costs, as we know, continue to rise. Very, very highly competitive. We see new entrants come into Australia all the time. How do you compete with someone like United Emirates who basically get their fuel for free? It's just a very, very tough business, and we just think there's significantly higher quality businesses out there. But saying that, back in 2007, there was a bid at what, $5 or $6 from memory.
That was the Macquarie Bank-led Babcock and Brown leverage buyout of some description, wasn't it?
Yeah, they got stopped by a major shareholder. I think Independent Asset Manager, or one of those guys, put a stop to it. But look, I think if someone's going to be interested at $5, surely at pretty much an even dollar, it's going to be more attractive to someone. But look, that's not our operation. We don't hunt for takeovers. We look for high quality businesses.
To add to that one, Russell?
Look, I just think we always prefer organic growth, and if we're looking at the gold space, we want a business such as Silver Lake Resources that can go from 100,000 ounces of production to 150 to 200 to 250 ounces, and have the reserve base of 10 to 15 years to be able to grow that production rather than do it by acquisitive means. But these mines, they're gold mines, they have finite lives. Once supply starts running out, or their oil quality starts to decline, they have to look at other avenues to find new resources to keep the business going, and mergers usually play a big part in that. So look, I just think we own Silver Lake Resources as our largest gold holding, and that business has a very good profile going forward.
It wasn't you guys buying Newcrest that pushed the price up today $1, was it?
Oh, I don't think we have that much weight. No, absolutely not.
All right, our next caller is Clint from Brisbane. Welcome to the program, Clint.
Yeah, good evening. I was just inquiring about shale gas play, Silex Energy in the Cooper Basin. Had a big run over the last 12 months, and in the last 3 months it's hit an anchor, I suppose, and they've just done a big capital raising, which has really hurt them, and they're below the capital raising. They've got $180 million now, though, but they have proven up the ground with their drilling. But obviously, there's a few question marks. I'm just wondering if any of you know what the question marks are and maybe why.
Okay, well, this is a topic that we've talked about on the program, I think, with you, and I don't know about you, Russell, in the past, but shale gas, it's a bit of a hot area. New Standard Energy, Buru, Senex, and the like. I think Elixir falls into that category as well. Senex, what are your thoughts?
Yeah, well, I think Senex is quite a good play in the sector. A lot of the Cooper Basin shale plays have come off quite significantly, and this one seems to be caught up in that. And I think having raised capital and having a lot of people probably selling out of that is probably not a good sign. This wouldn't be my preferred play. I think in this sector I'd rather go for the Canning Basin plays. If you're going to go for exploration, Buru, New Standard Energy, I think that's a couple of standouts there. With SXY, it does seem to have good tenements overall, and I'd just be, if I wasn't already in it, I'd just be watching for that share price to start ticking up. which perhaps we'll do soon.
Well, one of the emails that we're going to hope to get to tonight, but we're going to run out of time, was about Buru saying, is it going to get above $4? Okay, so if you're saying Buru is obviously a better buy, a better punt, you know, is there enough steam to push Buru through that level? Russell, quickly, anything to add, because we're going to finish the program?
Look, based on current analyst forecasts, this business is forecast to make around $30 million a year for the next couple of years. Currently, market cap is $720 million. Just ask yourself, would you invest $720 million in a shale gas play with significant risk for only $30 million a year?
Well, that's what we call a market with different opinions about different stocks. Unfortunately, that's all we have time for today. So thanks very much to our guests, Simon and Russell, and thank you to all our viewers for all your calls and emails. Until next time, I'm Kim Slater. Good evening.